Welcome back to IUL University. In this lesson, we will talk about IUL interest crediting and the basic variables that are used to determine how interest is calculated. We will define participation rate, cap, and floor, as well as the crediting period. Then we will provide an overview of the various crediting strategy options that insurance companies may provide. All IULs offer interest that is tied to the performance of an underlying index. In some cases, there will be more than one index used in the calculation, which we will cover later in this lesson. A stock index is defined as a measurement of the value of a section of the stock market. It is computed from the prices of selected stocks, typically a weighted average. The interest calculation is based on 4 factors: participation rate, cap, floor, and the crediting period. The participation rate is a percentage of the change in index that will be credited to the policy. The rate can vary from below to above 100% and is usually dependent on the cap. The cap rate is the pre-established maximum interest rate that can be credited to the policy. Higher participation rates usually mean a lower cap, and lower participation rates usually mean a higher or no cap. The floor is the pre-established minimum interest rate that can be credited to the policy. This is usually 0% to provide downside protection for policyholders. What this means is that even if the index rate goes down, your credited interest rate is never less than 0%. United of Omaha's IUL product will have a 0 floor. The crediting period is the length of time during which the interest will be calculated. The account will only receive interest at the end of the crediting period. For each premium payment made during the year, a new crediting period or bucket is established. There are multiple crediting periods that may be used. In annual point-to-point, the value of the index is calculated beginning and ending on the same day each year. For example, if January 15, 2017 is set to be the starting point, the difference between the index value on that date and the end date, January 15, 2018, would be the index value. Monthly point-to-point and multi-year point-to-point are calculated in the same way, just with different time periods between start and end dates. Monthly averaging takes the value of the index at the end of each month and then sets the index value based on the average of all 12 months in the year. Insurance companies may offer multiple crediting strategies for their policyholders to choose from. They may differ based on crediting period and participation and cap rates. Most policies allow the holders to allocate funds to more than one of the available options, which allows for more flexibility and diversification. In the case of Income Advantage, the product offers 3 crediting strategy options based on participation and cap rates. The first option will have a participation rate of 100% with a variable cap rate. The second will offer a variable participation rate that will be greater than 100% plus a lower cap rate. The third option will provide a lower variable participation rate under 100% with no cap rate. Policyholders can allocate their account values and future premiums across any of the 3 strategies. In addition, a fixed account will be available that will function similar to our current IUL policies. Let's take a look at an example of how these 3 crediting strategies could work within Income Advantage. In option 1, the participation rate remains static at 100% and the cap is variable, let's say at 11%. If the annual return on the S&P 500 is under the cap rate, the interest will be credited at that rate. Should the annual return rise above the 11% cap, the interest credited would only be 11%. However, if the annual return falls below the 0% floor, the account will not be negatively affected. In option 2, which offers a high participation with a lower cap, There is a chance to increase the interest rate should the S&P have lower returns. And the zero floor offers even greater downside protection. However, the cap will hold the interest down in higher return years. In contrast, the third option has no cap but a lower participation rate. This may provide a higher potential for greater returns in bull markets. As with the other two options, the floor is set at 0%, so the account will never go negative. Let's test your knowledge based on what you've learned in this lesson. True or false? The cap is the pre-established minimum interest rate that can be credited to the policy. The correct answer is false. The cap is the pre-established maximum interest rate that can be credited to the policy. Crediting strategy options may include variables based on A. Index, B. Crediting period, C. Participation rate or cap, D. All of the above. The correct answer is D. All of the above. In this lesson, we covered IUL interest crediting and the basic variables that are used to determine how interest is calculated. We have defined participation rate, cap, and floor, as well as the crediting period. Finally, we provided an overview of the various crediting strategy options that insurance companies may provide.